If there's one thing I've learned from years of watching crypto cycles, it's that making gains is only half the battle. Keeping them is the real challenge. Too many people ride their wins all the way up and then all the way back down. Now, I get it. Taking profits feels like betrayal when the market is euphoric. But here's the truth. Profit taking isn't about pessimism. It's about strategy. It's how you turn paper gains into freedom. Now, in this video, I'm going to walk you through one of the most practical, time-tested methods that I use myself, laddering your exits. This is a flexible way to secure profits on the way up without feeling like you've sold everything too early. And I'll show you how to do it without losing sleep or leaving gains on the table. So let's get into it. Laddering works because it removes emotion from the equation. In crypto, emotions are expensive. Greed tells you to hold just a little longer. Fear convinces you to panic sell at the bottom. Now, laddering, on the other hand, gives you a clear roadmap, so you're not making decisions in the heat of the moment. Instead of trying to time the exact top, which, let's be honest, no one consistently does that, you take profits incrementally as the price climbs. Maybe you sell 10% at a certain target, another 10% higher up, and so on. That way you're capturing upside without overcommitting at any single price point. Now, this strategy also works on the way down, because if the market starts reversing, you've already locked in some wins. You're not stuck watching your portfolio evaporate while waiting for another rally that might never come. It's about balance. Laddering lets you stay in the game while still protecting what you've built. And that is what long-term survival in crypto really comes down to. Setting your laddered exit targets should be strategic, not random. You're not just picking numbers out of thin air. You're planning based on your own goals, your own risk tolerance, and the behavior of the asset that you're holding. Start with your entry price, then consider realistic upside based on previous cycles, current sentiment, and macro trends. Let's say you entered Bitcoin at $40,000. Now that we're over $110,000, you're already in strong profit territory. And this is exactly when having a plan matters most. You might set staggered sell points like 20% at $120,000, another 20% at $150,000, and let's say 10% at $180,000. And maybe leave a moonshot portion in case we see $250,000 or beyond. The idea isn't to sell the top. You won't, but to lock in life-changing profits along the way. Now, to guide those levels, you can look at Fibonacci extensions, prior resistance zones, or major round numbers that attract trader behavior. Use platforms like TradingView to map them visually. And be specific about how much of your total position you'll sell at each stage. Some prefer even slices, like 10 or 20% at each level. Others scale out more aggressively the higher it goes. There's no one-size-fits-all answer, just a plan that keeps your emotions in check. When the market goes euphoric, the last thing you want is to be guessing. That's how people miss their chance. Having your targets preset means you'll be acting with clarity while others are frozen in FOMO. Now, one of the biggest advantages of a laddered exit plan isn't just financial, it's emotional. The crypto markets are a roller coaster, and the higher prices go, the harder it becomes to think clearly. Greed kicks in, fear of missing out replaces rational thinking, and before you know it, you're holding all your bags into a brutal correction. But when you have predefined exit points, you remove the guesswork. You're not reacting in the heat of the moment. You're following a strategy that you set when your head was clear. Now, each time one of your targets hits and you take some profits, you feel a sense of progress, and it feels good. You're not trying to sell the exact top. You're banking gains as the market gives them to you. That kind of discipline protects you from round tripping your entire portfolio, again, riding it all the way up and all the way back down. And it's not just about peace of mind. Every time you secure profits, you're giving yourself new optionality. That cash could be saved, reinvested, or deployed in other opportunities during a future dip. You're not out of the game, you're just playing it a lot smarter. So remember, it's not the person who holds the longest that wins, it's the one who exits wisely. Now, before you put your laddered exit strategy into action, there's one more piece you can't afford to ignore: taxes. Because every time you sell, you're creating a taxable event depending on your tax jurisdiction. That means each rung of your ladder could come with a capital gains bill, especially if you've held those assets for less than a year. So timing matters. Holding your position for over 12 months could move you from short-term to long-term capital gains, which is usually taxed at a lower rate in most regions. And in some regions, that means it's tax-free altogether. So please keep that in mind. This is why it's smart to layer in your tax strategy alongside your exit strategy. Work with a licensed tax professional if you're in deep, or at the very least, keep meticulous records of your buys, your sells, and your cost basis. Tools like CoinTracker or Coinly can make this easier, but the responsibility still falls on you to understand the impact of each trade. Because here's the truth: making the right moves on chain is only half the battle. Keeping what you've earned and planning for your future requires just as much care. So as you plan your laddered exits, think holistically. Don't chase tops, don't panic at dips. Build your strategy, stick to it, and let your gains compound over time, not just in price, but in peace of mind. And that's a beautiful thing. Now, this is how you stay in the game long term. This is how you win.